Welcome to The Lumber Word, where industry veterans Matt Beamer, Greg Riley, and Ashley Buckold dissect the world of commodity lumber each week. We bring you up-to-date insights on supply, demand, and market trends, sharing our trading expertise to benefit everyone in the supply chain. Join us for informative and entertaining discussions that guarantee to make you wiser about all things lumber.
Hey everybody, welcome to this week's episode of The Lumber Word, episode number 80. We're going to call this The Power of Information. So what we're going to talk about this week, first of all, Gregg and Matt are out traveling. It is that time of the year where everybody is on holiday and around the country, and they will be back next week, and we'll have some great shows with some amazing guests that we have booked coming forward. Again, we appreciate everybody listening, and we're looking forward to growing this podcast as it grows every week. One thing I wanted to talk about is, what are we going to talk about today? There we go. Today, we're going to talk a little bit about what we did this week, housing starts and permits. We're going to talk about market structure, what I like to look at, what we like to look at sometimes to determine what we want to do and what the market is made up of by what participants or who's in it. Then I'm going to talk a little bit about a call I had last night from somebody involved with a bunch of builders that was asking about risk management. And it brought me the idea of, let's talk a little bit about education and starting learning the simple things first, and then building from there. And then I will end it with talking about, depending on what node you're in the market, what you should be looking for, seeing, thinking about, planning, etc. So let's talk a little bit about the market this week and last week since our last podcast. The market has been in a steady sell-off since late March, early April, across the board. There has been a lot of hope. We did drop down in price, and a lot of talk about how we couldn't go below the cost of production for long. We are below the cost of production, I would guess, at most mills. And as you have noticed over the last few weeks, there is a slow trickle of information from mills, how they are rationalizing capacity over the next time period. When I say time period, next 3 to 4 months, with some small rolling curtailments, some mills taking some time off, trying to rationalize shifts, et cetera, et cetera. I would expect a lot more of that to come out if we stay here or continue to go lower over the next few months. We also have summer shutdowns in Eastern Canada, which are normal. They will start over the next few months. But again, as I said, that is to be expected. So what came out today to really sell us off some more in both the futures and the cash market? May housing starts. I think what May housing starts really told us in permits, what price has been telling us anyway for the last 30 days, that we are not building as fast or as much as we anticipated. And there is probably still one extra stick being produced than is being consumed. Markets are very efficient. They'll figure that out. So let's look at starts, down 5.5%. Year over year, that's down 19.3%. That was not expected. Building permits were down 3.8%, down 9.5% year over year. Northeast was down 2.5% on starts. Midwest down 19%. South down 8.5%. It looks like the West, if I'm reading this right, was up, had a decent print up. But as I said, multifamily is down 49.5% year to date. If you remember podcasts a few months back, we were hoping that multifamily would come back. It hasn't. It looks like that may be tough for the rest of the year. That could potentially put a lid on pricing. With that said, we'll also try to keep an eye on repair and remodel, which actually consumes more lumber than new homes. But if you look at pricing over time, it's telling us a story of maybe we were a little bit too optimistic coming into this year as lumber traders. With that said, let's talk about market structure in lumber. So what do I like to look at when I talk about market structure and look at what's set up on the CME? And I'm going to talk about the Chicago Mercantile here. So I liked to, when I separate things, talking about cash, spot, physical market, or CME market, I like to differentiate between the two so people out there know what I'm talking about. So the CME prints a daily bulletin every day after trading that usually reports on what the previous day's volume and open interest looked like. The reason I like looking at this on a daily basis is it kind of tells me the fuel that was in the market the day before and what the sense of urgency was. So if I look at the daily bulletin from the other day, there was over 3,000 contract traded. That's a high volume. And the way I come up with high volume, I kind of look over an average of the last 7 to 10 trading days, and I look at what's low, medium or high. We do have an expiring contract next month, so there was a lot of rolling, but I look at every day to see if the volume was high, what the price did, and whether open interest went up or down. I like to do this because it either confirms the trend or tells me not to pay as much attention to it. So, high volume day, price is up, open interest up pretty good. That happens over time, confirms a trend. If you had prices up high where open interest drops, sometimes that is just mere short covering. If it's on the way down, the market's trading down, good volume, open interest up, over time, that can confirm the trend. I like watching that to see what kind of urgency is in the market. Second report I like to look at, comes out once a week, is the Commitment of Traders report. It is put out by the CFTC. Cool report because it breaks down in buckets who's actually long and who's actually short. The buckets I like to look at are the producer merchant processor user. Those are called industry. So when I refer to that, it's going to be industry. I also like to look at managed money. Those are the people that have all the nice algorithms and computerized trading that like to scrape the internet and do all kinds of funky stuff to decide whether they want to be long or short. They got the propellers on their head and are looking at all kinds of things, but they are very important in a lot of the equity market and commodity markets, and one you have to keep an eye on because they trade a lot of volume. So the Commitment of Traders report has been really cool to look at over the last year. And I think it tells a story of where we're at and where we're going. And the way I look at it is very interesting. So when I actually have the chart up on my screen here, when you look, we went into the beginning of the year, the open interest on lumber was about 8,700 contracts. The industry was long about 2,713 and short about 7,000. Managed money was long 2,400 and short 197. And that's when the CME was about 578. So the industry built their short position up to almost 78.96 as of March 26, 2024. The managed money was actually long going into that. And that's where the CME basically went from 578-ish to 600 over that time frame from January till March. Then what becomes very interesting, when I look at it, the industry was short, hedging like they should be. And the market was letting me at a good positive basis during that time frame and roll everything that you should be doing. Again, this is just me interpreting this, so humor me and just take it for what it is. So around March, we know right before the Montreal Wood convention we all went to, the market started to trade off a little bit. You go into April 9th, and the market had dropped from 600 down to around 585. I'm giving in CME based. Cash was still a discount, and you had a positive basis. And you also had a roll where if you were a hedger, you could pick up money on the roll because the front month was giving you a discount to the next month you're rolling into. So as of April 2nd, your producers were still short 69.76. Your managed money was short, was long 32.39 and short 593. All right, so you start going down into April, this is where I see something interesting start happening. As of April 30th, the industry was now long 48.48 and short 30.69, and managed money went from long, liquidated, and we're now only long 326 and short 54.50. So managed money saw something around that mid-April and started getting short while our industry was getting long. This is just my thought process. Our industry, I think, from leaving the Montreal Wood Convention, still was optimistic, had hope, even though things were selling off. I think they believed that the price couldn't drop below the price of production for very long, and more mills would take production off quickly, or there'd be a rebound in demand. But as we know right now, that did not happen. So over time, let's fast forward to last week. Our industry on 6/11, the Commitment of Traders report, and you can get this off the CFTC website, was long 6,338 contracts, short 2,880 contracts. Managed money was long only 125 contracts, and short 6,033 contracts. So what does that tell me? It tells me that a lot of people got long somewhere around that 520 area of the CME price, and have now had to roll that once at somewhere between, let's say, best case $10, worst case $30 roll where they lost money on the long side, and have now, as of today, ridden that all the way down to about 470 and are staring at the shorts and longs. So the industry longs are basically staring at the managed money shorts and saying, okay, who's going to roll or who's going to blink? I think the way it's going to play out, I am not sure, is there'll be a decent chunk of that probably roll without any problem. That already have the last few days. But some of these long industry are probably going to that's not tied to any kind of forward sale, because if you remember in April when we were up in Montreal, multifamily was already off and there weren't many multifamily jobs. Yes, there probably is some long forward sales against some of this, but I think there is some longs in there that are long and wrong and are probably up against it now, especially with the market dropping down to the 470 area. So I think you're going to see some of those bail. I think you're in the process of that right now after you saw that sell off today. And I think we are going to try to put in some kind of bottom. I hate saying that because generally I could be wrong on that between now and the end of this month, or I should say, let's say before expiration in July. Let's just do that to be safe. I think people that are on the long side probably at some point will have to throw the towel in. Now, with that said, I think you're going to also see some other curtailments probably come out in the future. And again, acts of God, hands of God, things of that we like to say, things we have no control over. There could certainly be other events come out. But the way things are set up, it does not look like demand is as robust as we thought. I think we're still producing one more stick than we're consuming. And I think the rate at which mills took lumber off was a lot slower and less than people wanted it to be. Now, with that said, I think a lot of producers do take a lot of stuff off. And we saw this on the South when Dustin was on from Fast Markets telling us about how a lot of that capacity had already rationalized over time. They just don't make announcements on it. So we will see what happens and if there's some more announcements coming up. But the most important thing I want to tell you about is look at the daily bulletin every day and look at the Commitment of Traders report real quick. So like I said, July was at 470. September was around the 495-ish mark today as I'm recording this. I'm kind of debating right now. I think you could see that spread blow out really far where July goes a big discount to September if the longs do just decide to blow out. Again, just a guess. So we'll see. That'll be a bonus for any people that are hedged that want to roll again and pick up that premium. So let's talk a little bit about the call I had last night. We'll call the guy Bill, very involved in the home building process in a bunch of the states. I won't say exactly where because I don't want to dial in. He said I talked to a whole handful of home builders. We have a pretty good build with the, let's say 5 to 10 home builders I deal with. Currently, they only get 30 to 60 day pricing. I want to know who I can contact so they can get pricing out into over a year. So, brought up a great conversation when I got home and I was sitting in my driveway and all my neighbors were looking at me because I was on speakerphone and I think everybody could hear down the block. 45 minutes later, I had a great conversation, great information. I learned a lot, but here's what I came up with. So, risk management. What can somebody do to manage risk in lumber if you're a buyer, seller, and you want to look at things? I think the industry since COVID has gotten away from doing a lot of risk management, selling to builders, framers, in the like. They got more to a 30 or 60 day sales process. And we can argue back and forth what the reason is for that, but that's just where it went to. Multifamily was always the one that seemed to take a lot more of the 3, 6, 9, sometimes 12-month pricing on and have third parties doing it for them or, internalize it themselves through holding stuff short, putting stuff on the ground, et cetera. So what can you do for risk management in lumber? Well, there's a couple different options. You can hedge with the CME, and there's a variety of people that do that. You can do that yourself. Going into that, you are hedging a 2x4 Chicago contract that is a Hemfer Doug for Eastern Western spruce contract, but that has basis, roll, time, and freight risk that you accept when you do that. You have third parties that can do that for you. You also can do over-the-counter swaps. There are about 3 companies that do that. Fixed for floating swap, where you lock into a long or a short firm price off an index that settles monthly. Money goes back and forth depending which way the index settles that month. But your physical cash buy or sell, you then actualize by doing that yourself in the spot market with your current buyers or sellers that you have. So if that didn't confuse you enough on over-the-counter swaps, you can send me a note about it. I can connect you with the right people on that. Hedging with the CME, or you can buy forward. Buying forward is real simple. You go to the 15 or 20 people that sell fixed physical forward, ask them for a price, and they will give you a very specific price. The great thing about buying physical forwards from people, you are basically passing the risk on to them for the time and the basis risk and everything. In exchange, you are getting a firm price for them. With that said, if you are doing something like that, you should have all the basis charts and all the information to know over that time frame and looking at the strip of the futures why you are paying that price and what that price is. Is it the high end of the basis, low end of the basis? Do you have anything that you can negotiate with that? So that's something we'll talk about in the future here. But what I came up with when I was talking to this person last night, he asked why they can't get farther in 60 days. I'm like, have you asked? Why don't you go out and ask somebody if they can price 120 days to a year for you? I do know yards that do that. I do know people that do that. So the only way you sometimes get in life what you want is ask people for what you're looking for and have them put a number on it, make a decision for there. In this particular case, the person was looking to do a little bit more of a hybrid type of option spread off of specific items. And I understand what he was saying because his background was from finance. It's a little bit advanced for our industry, what he was asking for, although I have seen collars and the such put on things in the history of being in this business. My answer and my thought, and I thought I would share this with everybody, was what you want to do is make sure you first of all learn about what you're buying. I asked the person last night, do you know the top items that you buy in lumber that make up 80% of the spend? What are you spending on them? Does your current person, break it down between labor and lumber? So in order to compare what you're doing, you need to know where you're coming from, right? I said the best way to do that is to subscribe to Random Lengths Fast Markets that prints Twice a week, the price of lumber. On Thursday night, they print a really deep version of it, and it has a lot of information. Become very well versed in random lengths. In subscribe to it, whether you're a home builder or a remodeler, or ask about the different ideas on it, and then learn how to convert board footage and square footage to per piece and per unit price or per stick price, and the reverse, how you can take a stick price and look at per thousand board feet or per thousand square feet. This is really important because you need to know whether you're a trader or a buyer or seller or a home builder or buying at a large retail yard. What are my different options and what are different species trading for in different places all over North America? What are the good values? If I'm going to buy something, what am I competing against? How elastic or inelastic is a different price on something? How can I negotiate with people differently on lumber prices? Well, you can't unless you know how things are trending and what they're doing. So what I did was a cool little exercise and kind of looked at 2 points in time. One was March 22nd this year, and one was June 20th of this year. And I picked a few items, and I just looked at what they were per thousand and per piece price. And then I looked at around a couple retail locations to see what they're trading at today versus where they're printing at in the wholesale market. And the reason I do this is I like to see how elastic pricing is over time when prices go up or they drop. How fast do they react on the retail side when they go up? How fast do they react when they go down? Depending on where you are in the supply chain, you can use that in your favor and just use it for information. So let's look at some items that are just really basic. 2x4 8-foot stud. A 2x4 8-foot stud in Chicago in March 22nd traded at $483 a thousand or $2.57 a piece. Okay. This is very loosey-goosey, so there may be a little extra freight in it, but pretty close. Or as they like to say, close enough for government work. On June 20th in Chicago, that same stick on the wholesale side traded for about, June 20th being today, traded for about $390 a thousand, delivered into a car and unloaded in a reload. It's about $2.07 a stick. The handful of people I looked at selling it in Chicago was anywhere from $3 to $3.45 a piece. That's $647 a thousand. So that price is not adjusted down very much in the Chicago market. Atlanta market in March, $510 a thousand, $272 a piece. Today it trades around $440 or $234 a piece. When you look at the different places, those sticks are trading about $3.35 or $628 a thousand. Has not come down in price yet. And it takes a while because it'll take a while for the pricing at some of these, depending upon where they're at in the node and how they price their things, to come down in price, just like it goes up. But as a consumer, you get an idea if things are going to trend down the next week at a store or trend up. And you don't know that unless you look at this data. If I look at something like a fun one to look at, a 7/16, and this is crazy looking at this item. So in March of 22nd of 2024 to Los Angeles, a sheet of 7/16 was about $620 a thousand or $19.84 a sheet. Today in the wholesale market, that is about $3.75 or $12 a sheet. When I go up online in LA and kind of do the old Googler search, I see it as high as $18.70, which is about $583 a thousand square feet. So that price hasn't come down at some of the retail sector yet. And I do this over and over again and look at stuff. So what's important as a consumer is to know the area you go to, know what species and what data point on certain indexes that people point to when they're selling you, or if you're buying from them, and adjust it to the freight to you, and then know what it is per piece and per thousand board feet. Track it over time. I think it's important to actually chart the stuff, put it up, and so you can look at it over time and be more educated about how it works. So that was a little bit about education. I'd like to continue doing that as we do these podcasts, and hopefully we get the website up sooner or later where I can do some of these tutorials on video and show you how I look at different things and different tips and tricks. But the one thing I said I wanted to follow this up with, where are we going? What do you do if you're a buyer right now? What I've noticed are buyers, whether small, medium, or large, are running their inventories down to, I would say, on the lower end of what they normally are comfortable with. I mean, people usually like to keep, I think, about a 90-day inventory. I've seen people running it down to 60 days or below. The reason I think that's low is if you're in an area that buys car loads, by the time you buy a car from out west and it has to ship to somewhere, it can take 30 days plus to get to your location. So once you get below a certain level, it's tough to manage that. You start running out of certain things. Now, this market has allowed people to replace stuff very quickly with trucks, with distributors having a lot of available wood around. Why is all that available wood around? Because a lot of people thought the price was going up, put a bunch of wood on the ground. There's a lot of available wood. People want to move it. We can do that. So I would say at some point, people are going to decide to keep more days of inventory when they see something or some reason. Here's the theme. We are all looking for a reason to buy lumber right now, but curtailments and other things aren't the reason. It has to be more of a compelling reason. Yes, we're looking for production coming off, but we're looking for something more positive on the demand side. We haven't seen it yet. And unfortunately, that's why we're at where we're at. So what do you do? Well, I think the one thing that you do is look at where we came from. We're now below the cost of production at most places. Look at the business that you have sold in the future. How far out do you have business sold if you're a home builder, a remodeler, an industrial person? If you have business sold out and you can make a profit buying today, it seems to me that that is the thing that you should do. Go out and push customers if you're a place to lock in things if they have the business sold. I think these numbers are unsustainable. I'm not going to be the one to tell you when they actually reverse course and go higher. But I know that we're in one of these areas where it is going to happen. And you never buy the bottom. You only do that by accident. And just as you never sell the top, you only do that by accident. You got to stay in the market all the time. But we are setting up in this area where we're probably getting closer to that happening than we are farther away. So home builders, start looking for what your needs will be over the next not just 60, 90, 120 days. Ask people to put numbers on that for you. There will probably be a premium for that because you are not going to buy today's numbers at a discount in most cases because that's not how risk management works if somebody's going to absorb that risk. But go ahead and do that. If you're somebody that's just buying sticks, look at the prices of things right now. They're sold off. Kind of get a benchmark for where they're at, know how to price in dollars per thousand and per square feet and look at it. But the one thing for certain is I think that we are starting to see the things that we need to see in order to get something to start heading the other direction. Is it going to be much of a rally if we get one? I have a hard time believing that, but something will happen. If you're EFPing, make sure, or exchanging for physical. If you're sophisticated enough to be doing that, look for all the different people out there that EFP, that exchange physicals. If you're long some futures and want to exchange it for trucks or cars, find those people. We do it here. Contact us if you want to EFP some of your longs for lumber that we have at our many reloads all over the United States. All right. So again, I talked about where I think we're coming from, where we're going. I tried to explain the reasons why you should educate yourself on different things. It's a tougher market out there right now, certainly. It's not the same market we were used to a few years past, but I think we have a lot of sunshine in front of us. A lot of good things will happen once we clear out a bunch of these economic things going on. We get through some elections coming up here, but we are going to have a decent year for liquidity. I think this ship will right itself. but make sure you stick and listen to the Lumber Word every week. If you want to contact me, my email is Ashley, ASHLEY, at Sitka Inc. That's SITKA Inc.com. Ashley at sitgainc.com. Looking forward to being back with the crew, Matt and Greg, next week and our guests. And hope you all have a great week. Thanks for listening to episode 80 of the Lumber Word, and looking forward to doing it with you again soon.
Thanks for listening to this week's episode of The Lumber Word. The Lumber Word podcast is dedicated to engaging conversations about the lumber industry, including trading ideas, market trends, and evaluations of overvalued and undervalued assets. We wish to emphasize that the discussions and opinions expressed in this podcast are purely for informational and entertainment purposes. They should not be considered as financial or investment advice. We encourage our listeners to make their own financial decisions, taking into account their unique circumstances and financial goals, and to seek professional financial advice if necessary.